You're looking at the financial system's ultimate apex predator. As of May 2026, a mind-bending $22 trillion is quietly, relentlessly driving the entire global stock market. And get this, it's not controlled by some genius stock picker on Wall Street. It's a massive, automated machine operating right in plain sight. Literally every second, this behemoth is rewriting the rules of wealth creation, and the stakes have absolutely never been higher. You need to know what's happening to your money right now.
The $22 trillion secret, hacking the stock market. Okay, let's dive into this.
Because for decades, Wall Street sold us a story, right? To make money, you had to pay these highly educated, incredibly expensive professionals to guess which stocks would go up and which would go down. But a radical idea flipped that whole system upside down. An index fund doesn't try to beat the market. It simply becomes the market. By mirroring a stock market index like the S&P 500, it buys the same securities in the exact same proportions. No expensive stock picking, no guessing games. It uses passive management, basically hacking the stock market by just buying everything. It is ruthlessly simple, highly diversified, and incredibly cheap. But if this sounds like an obvious win today, you've got to understand that when this concept was first born, Wall Street viewed it as a mortal threat.
Laughed off Wall Street, the underdog story.
Before it became a $22 trillion overlord, this unstoppable profit engine was treated as a complete, laughable joke. The establishment absolutely hated it, and the underdog story of how it survived is wild. Let's trace the timeline here. It starts out as this purely theoretical academic model back in 1960, pitched by two University of Chicago students. They proposed this unmanaged investment company, which honestly got almost zero support. But the spark was lit. Fast forward to 1970, and we see the Qualidex Fund, the first open-end index fund for retail investors tracking the Dow Jones. But tracking the price-weighted Dow was super costly. Then, in 1973, Wells Fargo and American National Bank create the first institutional funds tracking the S&P. But the real earthquake? That happens in 1974, when John Bogle founds the Vanguard Group, inspired by those early academic papers. On December 31, 1975, Bogle launches the first index investment trust, which you might know better today as the Vanguard 500 Index Fund.
And Wall Street's reaction? Absolute visceral outrage. The active management industry was terrified of a product that exposed their insanely high fees. Competitors viciously mocked it, literally nicknaming the fund Bogle's Folly. They even ran these aggressive campaigns, slamming the very concept of settling for average market returns as fundamentally un-American.
Now, what's really interesting about this slide is a quote from Edward Johnson III, the chairman of Fidelity Investments at the time. He said he couldn't believe that the great mass of investors are going to be satisfied with receiving just, quote, average returns. The entire financial establishment thought retail investors were just too greedy, too demanding, to ever accept a passive strategy. And spoiler alert, they were spectacularly, historically wrong.
Because that little underdog fund, which started with a meager $11 million in assets, caught absolute fire. By November 1999, Vanguard had $100 billion under management. And the ultimate vindication? In the year 2000, Vanguard's 500 index fund surpassed Fidelity's mighty actively managed Magellan fund in sheer size. The joke was over, guys. Passive investing was officially taking the crown.
The passive profit engine. Why the underdog won.
And this brilliantly illustrates exactly how the underdog conquered the financial world. Pure, undeniable, mathematical efficiency. Look on the left. Active management is absolutely riddled with high costs. Why? Well, because you're paying analysts and managers. They also have high turnover. They're constantly buying and selling stocks, which triggers capital gains taxes that just eat into your returns. Plus, active funds suffer from this thing called style drift, where a manager might suddenly start buying high-risk tech stocks even if they're supposed to be running a conservative mid-cap fund, totally wrecking your portfolio's diversification. Now look on the right. Index funds offer the ultimate antidote. Because the target index is a known quantity, the costs to run the fund are basically nothing. They barely trade, meaning minimal turnover and highly efficient tax profiles. And style drift? Literally impossible. You get the exact diversification you paid for. It is just a mathematically superior profit engine.
Hidden traps and arbitrage. The dark side of passive income.
Now, before you start thinking this is some flawless, utopian financial system, we need to take a sharp turn, because anytime you have $22 trillion moving through a system, it attracts predators. period. And this unstoppable profit engine actually has a terrifying, hidden flaw built right into its core. It forces us to ask this incredibly provocative question: are index funds being legally rigged? As passive investing has grown into this massive titan, it's created systemic vulnerabilities that high-frequency traders are exploiting every single day. Let me show you exactly how this hidden trap works.
The problem is in the plumbing. Step 1. Index funds have to periodically rebalance to match changes in the underlying index. Because they're completely transparent, they effectively announce these massive institutional block trades ahead of time. Step 2. Algorithmic traders and arbitrageurs see this coming from a mile away. They anticipate the massive market impact of a multi-billion-dollar fund being forced to buy a stock. Step 3. They trade ahead of the index fund. This is a wholly legal practice known as index front-running or index arbitrage. Step 4. By doing this, they buy the stock cheap and sell it right back to the index fund at a higher price. Value is silently, legally siphoned directly from everyday investors' returns straight into the pockets of algorithmic traders.
You see, the sheer mechanical nature of index funds creates these perfectly predictable ripples. When a company is added to an index like the S&P 500, the index funds are literally forced to buy it, creating this massive demand shock that artificially inflates the stock's price. And when a company is deleted, they're forced to sell, tanking the price. The savvy predators on Wall Street game these exact supply and demand shocks. This results in costly tracking errors for the index funds. It's just a constant, invisible bleed on the entire system.
Buying the entire economy. The new monopolies. Let's move to and see how this builds.
Because we aren't just talking about algorithmic traders skimming a few million off the top anymore. We are talking about the fundamental structure of global capitalism. We're talking about the consequences of $22 trillion buying literally everything. We are shifting from what researchers call shareholder primacy to asset manager capitalism. According to political economy researcher Benjamin Brown, in the old system, investors had a direct interest in the performance of specific individual companies, right? They wanted their company to win and beat the competition. But today, under asset manager capitalism, a few gigantic asset managers own vast percentages of every single company in a given sector. Think about it. If you own all the airlines, you don't really want them fiercely competing to lower ticket prices. You benefit from monopolistic prices across the board. These massive asset managers usually just vote in lockstep with company management, profoundly changing how corporations behave.
And this leads us to the extreme endpoint of this consolidation. In this new regime of common ownership, asset ownership is technically diversified, sure, but the wealth definitely isn't. The reality is that it's a small part of the population actually investing in these funds, with the top 1% of the wealth distribution owning 50% of corporate equity and mutual funds. These giant asset managers have effectively bought the economy. And researchers point out that negative externalities, like economy-wide wage stagnation, are an expected outcome when competition is just stripped away by universal ownership.
Which leaves us with this final, massive unknown. The index fund started as this brilliant underdog idea to save everyday investors from Wall Street's greed, and it succeeded beyond anyone's wildest dreams. But when a $22 trillion automated machine literally buys the entire economy, eliminates market competition, and concentrates corporate control into the hands of a few mega managers, what happens to the rest of us? That's the question driving the next era of finance, and it's one you absolutely cannot afford to ignore. Thanks for watching this explainer. I'll see you next time.